Mark Lowdy here. If you're a shareholder in Capitaland and you haven't yet read the annual report ahead of the annual general meeting, help is at hand. We're not going to replace the annual report with this program, but hopefully help you a little bit along in reading it. James Leong is here. He's the Chief Executive of Visions One Consulting, and as a member of the Executive Committee at the Securities Investors Association, he designed the course Analysing Company Performance for Smart Investing. Hi, James.
Hi, Mark.
How did Capitaland do in 2011?
Great. Results overview, another year of profit in excess of $1 billion.
All right, and that's they've had a couple of years of that now, haven't they?
6 consecutive years, in fact.
But Capitaland is actually a little bit more than just a property company, isn't it?
It is, and so it's very important to understand their corporate strategy to understand the financials in the light of their corporate strategy. So let's take a look at the corporate strategy. 3 key areas. First of all, the focus on Singapore, China, and Australia. Balance across real estate sectors such as residential, such as shopping, offices, service residences, and mixed development, and also scale in real estate sectors. So let's talk about focus first. Where are most of the assets being concentrated? 3 key markets: Singapore, China, and Australia.
Right, they used to include Vietnam in that, but when you go along to the AGM, ask Liu Leong whatever happened to Vietnam. And you can tell them that Mark Lowdy asked you to ask that question. So where is most of their assets then coming from now?
Yep, the 3 markets, most of their assets, Singapore, China, and Australia. And 97% of their income, which is EBIT, comes from the same 3 markets as well. So very important markets to the company and the group.
You know, one of the other things that investors sometimes don't quite catch a hold of is the remarkable differences between different types of property. We all tend to talk about the property market as though it was one market, but in actual fact, industrial, residential, commercial, retail, and all of those other, I mean, they're very, very different markets with very different market cycles.
Absolutely, and it is important. That's why the company goes into what's called a balanced portfolio management strategy, so as to, because there are policy headwinds depending on how overly heated some segments of the market might be. And one of the ways to deal with that is to go into have a multi-sectorial strategy. So for example, if the resi market is very heated up and governments impose certain cooling measures, the retail side is in a way unaffected. And this is where the company will be able to make its money. And
that's why these 2 pie charts on the screen seem to look much the same. I mean, even though they cover different markets, Singapore assets on the left, China assets on the right, actually the way those pie charts are divided is pretty similar, isn't it?
Yes, that's right. And the third thing, take a look at the scale. So they have a total committed project size of ongoing development projects of $60 billion. So there's quite a lot of projects in the pipeline, which the group has already been committed to. And as you mentioned, rightly, apart from the different sectors that the company operates in the real estate space, they are also into the financial services space. And in fact, they are one of Asia's largest real estate fund managers, managing 6 REITs and 15 private equity funds.
Right. Now, you mentioned that they had a 6th year now of more than $1 billion in net profit. Let's see how we can break that down. This next graphic shows you the revenue, EBIT, and where it says PATMI, that's profit after tax and minority interests. But you know, James, the percentage changes are actually all negative. So even though, yes, PATMI is more than $1 billion, it's actually down 26% on an 11% fall in revenue. So I guess they're right, more than $1 billion in profit for 6 years, but it's actually a fall. Should we be worried about that?
Yeah, let's take a look. Let's dig into the details. And we are looking at the income and EBIT statement over here. So what you will find is that Capitaland Residential Singapore, there is a decline in terms of their revenue numbers.
The numbers are quite small, in case you can't see that. That says 1.28 billion down to 774 in 2011.
Right, and Capitaland China Holdings has increased and Escort has decreased. So all this will have an impact on the corresponding EBIT. So what are the reasons for that? So for residential Singapore, you'll find that again, because given the project nature of the business, so you've completed a project in 2010, you recognize all the revenue. Now this year, if you haven't had major contracts that's mature, but you're in progress, so you can only build part of it along the way. So depending on the timing of the project recognition, you could experience a decline in revenue.
Yes, and now that the international financial regulations are changing, is Capitaland impacted like other developers that will only be able to recognize revenue once the value has actually transferred to the buyer?
Certainly. On those what's called the deferred payment scheme type of projects, the answer is yes. On the overseas projects, the answer is yes as well. Otherwise, if you're talking about what's called progressive payment type of scheme, then they will still be using what's called the percentage of completion method, which is recognizing it progressively.
Yes, even though they haven't actually sold any units, they'd still recognize the revenue once the unit is completed. So in theory, we're actually going to see all of the property developers report much more volatile earnings as projects are completed and new projects get underway.
That's right. That's something that we can expect.
Right.
Yep.
Okay, but still on an earnings per share basis, how's Capitaland doing?
On an earnings per share, we find that as a result of the reduction in EBIT, yes, declined to 24.8 relative to the year ago, which is 33.5. Yep.
All right. Now, also we need to look at working capital, because if you're a property developer, you need a lot of cash to buy building materials and do all of those other things that developers do before they get the money from the buyers. So how are they doing on the working capital front? How liquid are they?
Okay, working capital actually improved. So we look at the current ratio, it was 3.53, and this year it was 4.23.
Right, and so for all of those who forgot our accounting lessons in school, what does that mean again?
Working capital is simply you take your current assets and you subtract your current liabilities. So it's a measure of your ability to pay off your short-term liabilities as and when they fall due with your short-term assets.
So the higher the number, the better?
The higher the number, the more liquid the company is considered to be.
All right, and we see that also in the balance sheet and liquidity position table, which they've kindly drawn up for us. You'll be able to find this in your own copy of the annual report. Interesting, I mean, where it says increased, you also have to look. It's an increase doesn't necessarily mean better. For example, net debt has increased, and a couple of other things have decreased. Cash, for example, has decreased. The fixed rate debt, the amount of debt that they have that's on at a fixed rate has also decreased. What should investors do with this table? How should they read this?
The important thing is, again, to understand the underlying causes behind the numbers, to be able to appreciate the context that the numbers are being generated. So first of all, when we are looking at so Capitaland, they used to have only 0.2 in terms of their net debt to equity ratio.
Right. So every dollar that they have, 20 cents, they have 20 cents in debt.
In debt, that's correct. So relatively for a huge property development company, you'll find that it's rather low. So what they are doing is to really leveraging on the balance sheet so as to make it more productive by getting a little bit more loans, in which case it will actually enhance your return on equity to shareholders. So that's one, and given that the borrowing cost is at a historical low, so it does make sense to tap the debt market rather than use shareholders' money. So that's one thing. The other thing is also that they have, when you look at the relative percentage of fixed debt. So last year they have a larger percentage, and this year there's a relatively lower percentage, which is 66% relative to 72%. So again, that is when you have a large proportion of fixed rate debt, it is good from management of volatility perspective, meaning to say that you don't get all these spikes in terms of financing costs that might throw your income statement out of whack. But on the other hand, fixed rate debt is normally higher. It costs more than short-term floating rate kind of debt. Right. So in this case, the company has just a bit of rebalancing to tap into the short-term opportunities.
Yes, and anyway, we're not going to see an interest rate increase for perhaps another 1.5 years or so, late 2014, if the Federal Reserve keeps its word.
That's right.
So presumably, it doesn't matter that it's a non-fixed, a floating rate interest rate at the moment, because they're anyway flatlining.
Yeah, it's really to take advantage of the differential in pricing.
Right, okay. And in terms of forward investments, what are they going to do next?
Yeah. Back to your other question, which you mentioned about the fact that cash has declined from 7.2 billion to 6.3 billion. So that's really, again, coming from a perspective of better utilization of cash, and which is in line with gearing up the balance sheet so that they can deploy the funds. So if you remember last year, the company said they're going to deploy $6 billion of funds into investment projects, but in fact they did better this year, and they've committed over $11 billion of investments, both in, and 99% of these are in Singapore and China.
Yes. The funny thing about property companies too is that they frequently trade at a discount to their net asset value. So if you take up all their assets divided by the number of shares, you actually get a higher number than is traded on the stock market. Isn't that curious?
Yeah, that's the way it is for property. That's how property companies are being valued. Yeah. And let's take a look at, given all their committed projects, which $60 billion they're going to spend on, and more active use of equity. So looking at their ROE, which is currently standing at 7.3 relative to 10.5. So
last year, yeah.
Last year. So I think we should expect ROE to continue to improve going forward, barring unforeseen circumstances.
Right.
Yeah.
The other thing that shareholders sometimes ask about is why can't the company go debt-free? If it has cash, why can't it just pay off its debts?
Yeah.
The answer, obviously, is that companies wouldn't be maximizing their assets if they didn't borrow against it. But at the same time, they need to be careful about the repayment schedule. So is Capitaland under pressure to repay any of its debts at the moment?
Doesn't look like it, Mark, because if you take a look at their debt maturity profile, so you could see the graph is nicely spaced out. In fact, due within 1 year is 0.86 billion, which is just 7% of the debt. And in fact, the company has a policy to ensure that not more than 20% of the debt matures in any 1 year.
Right.
Yeah.
Oh, that's very interesting. And do they have the bank balances in order to do that?
Yes, and if they need to, they have unutilized facilities and their funds available, including their cash of almost $10 billion.
Right.
And this is available, and also their funding platforms is across bank borrowings, capital markets, REITs, private funds. So they do have the ability to tap into more borrowings if need be.
Wow. Okay. So the banks have said, hey, if you want to borrow 10 billion from us, go right ahead.
Yeah.
It's nice when the banks say that to you.
That's right.
Okay. What else are we looking at in the annual report? Cash flow statements. Why don't we look at cash flow? This is my favorite part. Cash is king. So are they generating cash?
Good. So there are really three portions of the cash flow statement. So the first thing we want to look at, which is the cash flow from operating activities. So how are they faring in this case? You will find that last year they were generating $902 million of positive cash.
Right, and this year it's a figure, it's in the 4 digits. It's very hard to read. It's a little bit small.
Yeah, that's right.
Go to your copy of the annual report. You'll be able to find this. But it's in the billions. It's at 1.8
no,
billion.
it's negative.
Oh, I'm confusing that, you see. I thought that was a 1. It's actually a bracket.
A bracket.
By the way, brackets means negative.
Yeah, $808 million.
Okay.
Yep. So cash flow from operating activities is negative rather than positive.
Oh dear.
And now if you take a look at it, the main reason, you can see that particular line, which is the development properties for sale. So as we can imagine, developmental properties will consume a large amount of cash. So it's not inconceivable that the cash flow from operating activities can be negative given any particular year, given the project basis and the huge amount of pipeline that they are working on.
I see. So with a property company, you might not be as concerned as with any other company manufacturing goods if their cash flow negative.
In a way, yes, but we will expect this to turn positive on project completion and collection of money from the customer. So really, we are looking forward to that.
The cash from investing part of the cash flow statement shows us where they're investing in fixed assets and so on.
And investments in the other companies, that's correct. And we can see it's 1.1 billion, last year 1.8 billion. So that's largely consistent with the amount of money they say they are going to be setting aside for investment projects. So that's investing for growth and revenue stream. And the third and final part of a cash flow statement is cash from financing. How are they financing all of this growth? Well, as we have seen earlier on, proceeds from bank borrowing, so they're borrowing more. At the same time, they're still paying dividends. So overall, there was a net decrease in cash, and that just brought down their bank balance from 7 billion to 6.2 billion, which is still a fair amount of cash on the balance sheet. And of course, investors all want to know whether they're going to continue to get paid dividends. Yes, and looking at their track record from 2007 to 2011, so they've been consistently being able to pay an ordinary dividend per share, and they're going to declare, they paid 6 cents, and they're going to add another 2 cents of special dividend for 2011. That'll make shareholders happy when they go to the annual general meeting of Capitaland. Thanks very much, James Leong, for talking us through it. Thank you.